Good afternoon, everyone. I hope we're all super excited to talk about economics for the next hour. There's going to be a lot I'm going to cover today. There's going to be a lot of macroeconomic trends, a lot of market-specific trends, some trends that are involved in your particular industry. And the first thing I want to get across is that I really hope you take this information back to your business, because at the end of the day, I can dump all this information, all this data on you, but it's about what you do with it. So hopefully I can give you some relevant information that's applicable to your everyday business that's not just economic related. All right, so the first indicator that we're going to look at in terms of the macro economy is GDP. Right, so GDP is the largest barometer that we track for the U.S. economy. It's very large, it's the largest metric we track. And you're going to see this chart quite a bit today, so I will take a step back to explain it. The left-hand side is looking at the historical GDP performance through time. Those teal bars there are our forecast for the U.S. economy. The right-hand side is the business cycle for GDP through time, as well as the forecast in the light bars there, or the light teal bars. What you can see is both the left hand and right hand side, we're riding a really hot positive train right now in terms of the U.S. economy. We're doing really well, but this is just not going to last forever. You have to know that we are going to be entering into a period of slowing growth in 2019, and that's reflective on the right-hand side, where you can see those bars there are going to be declining, that we're basically on the crest of this economic wave. And there are very different strategies to take away in that particular phase of the business cycle. So when we're in business cycle decline, there are more cautionary metrics or cautionary management objectives to bring back to your business compared to where we currently are right now, where we're still riding that really positive wave in the U.S. economy. So I'll get into the headwinds that are going to be propelling that business cycle into decline, but know that even at its lowest point, we don't expect recession out of GDP late in 2019. And that's reflected on the fact that the bottom part of that forecast in the right-hand side is going to basically scrape along the zero line. So we don't expect recession to actually happen in the U.S. consumer economy. The definition for recession is 2 consecutive quarters of decline. We're not going to see that, and that's reflected on the left-hand side, where there's just not going to be 2 consecutive quarters. So know the growth will be softer next year. Also know how you relate to the economy. Do you lead it? Do you lag it? That's very important as well, because just because the economy is thriving right now doesn't mean your business should be thriving depending on how you relate. You could feel that positivity, a year from now. It all depends on how you move with the economy, and I'll get into that as we head into today's presentation. But a large factor that we look at in terms of where are the organic opportunities going to come from? We're looking at migration here. So those states that are having a lot of people move towards them, they're going to have naturally organic new opportunities facing them, because there's just going to be more people to consume in that economy. There's going to be more, just a larger presence. So in terms of where you want to focus your efforts on, definitely focus on those bluer states if you're operating on an overall U.S. scale. Because those more orange color states, the more salmon color states, those aren't going to be naturally organic opportunities for you just because it looks like people are leaving it. California and New York, cost of living is extremely high in those areas. California as well, I visited that state a couple times in the past year, and what I've heard is they're very in favor, the state's in favor of the business, of the employees and not the employers. So we're seeing a lot of businesses up and move out of the state, which can clearly be reflected too in the blue states surrounding California, where the Northwest is very millennial-centric. You have the Colorado and the Texas region, they're really good to do business in. So we're seeing a lot of organic growth opportunities and migration there, which is going to just be a natural upside bias if you're focusing your sales and your marketing strategies toward those bluer states compared to, your Midwest states are suffering right now with negativity going on in migration. Now, this does not include immigration. So once we work immigration into the mix, what we get is our population growth. And now you're seeing a whole lot more positive trends going on. All but 3 states are in the positive when you look at population growth. So now that immigration is considered and integrated into our expectations for population, paints a very similar story to the migration pattern, where you're still seeing that positive trend coming from the northwest, the south, the southeast, and the Midwest is still the area of weakness. But at the end of the day, it really shows you how much immigration is impacting our population, and especially in today's tight labor market. If we put any more, strict guidelines on immigration policy, it's going to drive up wages. And already at a point when we're in such a tight labor market, you have to be cognizant and aware that we're facing huge inflationary pressures right now. Not even only on the wage side, but across the board, especially in logistic costs. It's just hard to find the labor out there. So really hone in on the areas of natural growth for you. With those states such as the Northwest, Colorado, you have your South, Texas is a great location to do business. We find a lot of opportunities there, and then the Southeast. When we talk about state-level opportunities too, we created this internally at ITR. It's an opportunity index that ranks the states to do business in from 1 to 51. And the reason there's 51 is because we include DC in that mix. But what this is it weights several different factors. It weights population, it weights migration, it weights employment, it weights the cost of living. It has many different factors that get integrated into it. So you definitely want to focus on those left-hand columns, because that's the 1 through 10 ranking. And on the right-hand side, you have the lowest ranking states. Those are going to be more challenging for your business. So definitely focus on those left-hand states, because they will create the most robust opportunities. All right, so we talked about GDP already. We talked about the consumer, but due to the nature of your businesses, a lot of you probably don't move with the consumer economy. You probably move better with the industrial economy. That's another macroeconomic indicator that we track. So this is what U.S. industrial production looks like. Again, left-hand side is historical data as well as the future activity for the U.S. industrial economy. The right-hand side is the business cycle. So it's another macro indicator that we track, but you probably are moving more in line with this particular market, because the three main breakdowns of industrial production are manufacturing, mining, and utilities. So given the nature of your business, you probably move better with this particular metric that we track for the overall macroeconomy. Again, though, very similar movement to the U.S. GDP, though, where we're seeing a really hot positive runway and a hot positive train going on in the U.S. industrial economy. But we are on the crest of that wave. So we are seeing the signs. In the next slide, I'll get into it about what's propelling us into this decline. But just know that this is not going to last forever, that this positivity is going to slow down by 2019. And on the right-hand side, what you'll see compared to GDP, this is now going into recession. Meaning, yes, it's going to be on the business cycle decline, but it will enter into what we call recession compared to GDP, which will avoid recession. And given the nature of your business, you probably will feel a little bit harder in 2019 compared to 2018, again, depending on how you move with the macroeconomy. But what we're seeing is the signs that are pointing towards the decline. The silver lining in all of this is that you know it's coming, right? So you know there's a recession that's on the horizon. You also know that it's going to be mild. The depth of that recession, as you'll see at the trough, is not going to be comparable to at least the last 3 recessions. 15 and 16 was oil and gas driven. It's not going to be mimicked as we head into late 2019. 2008, 2009, housing market, early 2000s, technology, all of that stuff that drove that downturn. The upcoming downturn will be mild and it will be brief. So prepare yourself for a slowdown, but know it's not going to last forever, and have all hands on deck when capacity comes online again later in 2020. All right, so let's talk about some of the drivers to this downturn. What we're looking at here is U.S. industrial production. This is the rate of change, the business cycle, as well as the forecast for U.S. industrial production. So what you just saw on the right-hand side of that graph, but what I'm about to show you are the leading indicators that really suggest we are going to be entering into this downturn next year. And these have already been shifted according to its relationship to the U.S. economy. Because they all lead, they're going to be shifted to the right. So this G7 indicator has been shifted to the right by about a year or so. We can see it's already in phase D recession. So that's one metric that we track that really suggests we will enter into this downturn. Great historical correlation as well. So really good news, or not necessarily good news, but confirming news that suggests our forecasts are going to be accurate as we head into 2019 with that business cycle decline. One of my personal favorites is looking at the U.S. Purchasing Managers Index. This one has an excellent correlation historically, and this thing peaked late in 2017. So we really do expect that a very near-term peak is going to develop in U.S. industrial production, and that green line is now below zero. So we're definitely seeing some negative signs from the manufacturing economy. That's typically what the Purchasing Managers Index tracks. Really corroborating our expectation for 2019. We have the Wilshire market cap, stock market related indicator, also in a general decline. It's been vacillating quite a bit, but nonetheless, overall decline. And on top of that, we have the JP Morgan indicator. These have all been shifted to the right. So it gives us really great predictive insight for where we're going to head into the future. A fun indicator that we've actually found after we created our forecast for the U.S. economy is looking at this. The blue line is retail sales. So that's another metric for the macroeconomy. That red line is a 16-month leading indicator for the economy. And what it's showing is it's inverted. So the negatives on the top there on the right-hand scale, the positives on the bottom, what it's showing is how often people Google the word recession. So we're seeing that, over the course of the past year and a half or so, a little less, we've seen an influx of people Googling the word recession. And even looking at it back in 2008 and 2009, seeing the aggressive spike up, which is technically a decline, that happened 16 months before the bottom of the Great Recession. So really great predictive insight that's suggesting we're going to be in the decline. It's just a fun indicator that we like to look at. All right, shifting gears slightly, what we're looking at here is U.S. non-defense capital goods new orders. Again, trying to take a step back to explain this chart. This is the first time you'll be seeing this type of chart. Is that top line, those gray and green lines, are the business cycle. So that's what you saw on the right-hand side. The bottom line there is what you saw on the left-hand side. That's the actual activity. So the top line is suggesting we are in business cycle decline. The bottom line is suggesting we're still seeing positive trends happening from the actual data. So over the course of the last 12 months, U.S. non-defense capital goods new orders, fancy name for B2B activity essentially, is at $811 billion in change. The great thing about tracking the cycles instead of just tracking the top line data is that the shifts in the cycles develop before they typically happen in the top line data. So what we've seen is a peak in both that gray and that green line on the top there. It's now in decline well before it's ever happened in the top line data, which is shown on the bottom there, indicating this gives us extra predictive insight for my business if I know my business is in business cycle decline, if I know my markets are in business cycle decline, well before it ever manifests itself in the actual top-line activity data. So B2B activity, it's doing well right now. It's still up 7.4%, but it is in that slowing growth trend. We're seeing interest rates rise. There's been about 7 or 8 hikes since 2015 by the Federal Reserve. That's going to increase the cost to go out and borrow, and that's going to limit the incentive for businesses to do so. So we're seeing that as an obstacle as we head into 2019. Especially with the inflationary pressures, and I'll get into the tariffs in a bit as well, because those are also creating a lot of inflation due to the limited supply. All right, so talking B2B activity, what we're looking at is U.S. non-defense capital goods new orders. That's what we were just looking at. It is in slowing growth. That's that orange line there. And a great leading indicator for U.S. non-defense capital goods new orders is small business optimism. Are people optimistic? Are people not optimistic? And you can see the sharp decline that's happened in that blue line. Business optimism is declining and down, so really suggesting that there is a preponderance of indicator evidence that suggests we will be in this period of business cycle decline. All right, so what I've talked about so far is a very macroeconomic level. What I'm going to hop into now is what does this mean for your business? How can you utilize your own data, go back to your business, plug in your data, extrapolate these rates of change so you can compare them to what we've seen so far. So the best part about this data preparation is you can track whatever you want in your business. What means most to you? Do you care about sales? Do you care about revenue? Do you care about new orders or actual activity? Do you care about anything that's shipped if you're commodity related? That's the best part about tracking these rates of change. So what we look at here is historical data. This is just an example, but for this purpose, let's say it's $1 million in sales per month. So we've seen November 16 to October 18, a lot of volatility going on in the sales. We don't really know if 1 month of rise constitutes an overall growth trend. So what we like to do is we smooth it out. We smooth that sales performance out to a 3-month moving total. What that suggests is take the last 3 months of data, so that 5.3 million you're seeing in October of 2018 is August, September, and October summed up. It's essentially a trailing quarterly performance. So the second we get November data, we'll drop August off and then add September, October, November. The challenge with this is it does not strip out seasonality. If you're a construction company, obviously your summer months are going to be higher than your winter months. It doesn't mean because your sales are rising from winter to summer that your business is doing better. It just means you're vulnerable to the seasonal patterns. So we strip out that seasonality by comparing the same exact hot or cold point of the year to the same time last year. So what we're looking at is October of 2018, 5.3 million in sales is up 10.4% from the 4.8 million achieved in October of 2017, so 1 year ago. Now looking at just that one particular growth rate on that 312 rate of change at 10.4%, great, double-digit growth. Who doesn't want to be in double-digit growth? But you have to track this every single month to get where you are positioned and identify where you're positioned on the business cycle. Because if you look at where you were in June of 2018, 16.7% growth. Now it's a lot less than what we were in mid-2018. It's very important to identify where you are in the cycle and be tracking your data every single month, not just at a quarter end or at a year end. We smooth this out even further into a 12-month moving total. So same exact process with the 3-month moving total as a trailing quarterly performance, but now we do a trailing annual performance, indicating that 20.3 million you're seeing is just the last 12 months of data aggregated. And again, we drop off November 17. Once we get November of 18 data, it gives us a new annual sales performance. Again, stripping out or creating the business cycle that renders us the 12-12 rate of change. This is what typically you see in several of the indicators that I will be going through today, indicating that over the course of the past 12 months, the aggregated sales data at 20.3 million is up 12.7% from the year ago level, so the October of 2017's 18 million. Similar picture to paint here where we're seeing double-digit growth. Awesome. Who doesn't want to be in that position? But if you're tracking those growth rates through time, you'll notice March of 18 was at 26.7% growth. That's double the amplitude. So that declining growth rate indicates you're in a slowing phase. And again, there's many different strategies to take away in this particular phase of the business cycle compared to an accelerating trend in those growth rates. And another advantage of tracking those rates of change is they pick up transitions before it ever develops in your top line data. As you'll see, the 12-month moving total column there at 20.3 million, that is yet to transition to decline. But we've seen the transition to decline in the rates of change over 2 quarters ago. So we get extra insight to where my top line data is about to head. So this is giving a more visual perspective of it. So this is, again, the top line data. That's that 12-month moving total. That's the historical trailing 12. What we're seeing is we're in the depths of the Great Recession on the top line, right? So we're in decline. Our sales are down. They keep declining. Not a whole lot of optimism in place because I haven't seen a huge turnaround yet. However, if I'm tracking my rates of change, which are on top there, that orange and blue line, what I've seen is that 312 rate of change, that orange line has troughed out, the blue line has also troughed out, and they're both rising. That's suggesting, oh, I'm in business cycle rise. Positive things are probably going to come out of my top line. And lo and behold, they develop. That transition to rise actually happened in the top line data, but we picked it up. We knew it was coming because we were tracking those rates of change. And the same thing can happen on the top side of the cycle as well, where we've seen that peak develop in both the 312 and the 1212 rate of change well before it ever developed in the top line data. You can see where that 1212 peaked. If you go down, that gives us a lot of insight. So it's very important to track your rates of change, utilize the data methodology and the math behind it to track those rates of change. And it's very beneficial because now you can compare apples to oranges or apples to apples in terms of looking at where your business is compared to the cycles you saw in, let's say, GDP or U.S. industrial production. And this example goes on and on and on, but I think I explained myself pretty well, so we're going to move into the next slide. Let's see. Tariffs. Tariffs and other fun things. Let's get into that. There's a lot going on, especially recently with the tariffs, and I just read an article that was talking about how there's a 90-day time frame on when these tariffs are end. At the end of the day, these things are somewhat unpredictable, where we don't necessarily know when they will end. China is a very prideful nation that will have a lot of susceptibility to basically keeping their pride, and they'll suffer more because of these tariffs. But at the end of the day, huge inflationary pressure. That's what we're seeing here. What we're looking at is the actual and proposed tariffs in the U.S. reaching almost over $900 billion, including the proposed, and then the reciprocal tariffs as well. So what this image is trying to portray is not necessarily the difference between the U.S. and the reciprocal tariffs, but the magnitude of it, where it's a huge number. And what that does is that throws a wrench into the chain that's going to really hurt the natural organic supply-demand factors. And when you limit supply, that's going to create inflation. We think specialization is a good thing. If China is good at doing something, then let them do it better. And then it allows us to figure out our specialization, allows us to focus on the things that we're good at doing and deploying them in the most productive manner. On top of this, the idea, too, of the tariffs was it would create a lot more domestic jobs. It would open up a lot of activity in the U.S., at least for the example I would like to use is for the steel industry. It would create a lot of extra steel jobs. But where are we going to find the people? We cannot find workers right now. I've encountered so many individuals that say that in their business they cannot find the people. The demand is there. There's activity going on. It's just finding and retaining as well, on top of that, the workers. Because there's a lot of turnover going on in a expansionary economy where people can get up and leave because they're confident they'll find another job. There's just not enough workers out there to find the jobs, even if they open up. Even if these tariffs were to create extra jobs in the U.S., it's about finding the labor, because right now we're not finding it. All right. Changing gears slightly here, we're looking at, you saw earlier, U.S. non-defense capital goods new orders. That's that blue line, as well as our forecast for those two solid blue lines moving forward for the B2B activity, and that this is already in decline. And one corroborating factor is looking at the utilization rate for machinery manufacturing. That, yes, it might have ticked up in the recent quarter or so, but overall general decline happening out of the utilization rate, really confirming our expectations for further decline in the economy. All right, so let's talk manufacturing. So talking about the manufacturing utilization rate, what we're seeing now is almost record high manufacturing activity. So this is looking at manufacturing production, those light yellow bars there are times of economic recession. So even in the past, we are achieving record high manufacturing activity. There's a lot of rhetoric that says manufacturing in the U.S. is getting gone when, in fact, it's not. You can see that, yes, it took a dip in 2008 and 2009 and the early 2000s, but we're creeping back up towards that record high from before the Great Recession. So it's there. We have the capabilities. We have the advantages in the U.S. to stay very competitive in manufacturing. We have the skill, we have the talent, we have low energy costs. Our energy costs are half of that paid in Europe, and our energy costs are a third that are paid in Japan. So we're very competitive in terms of our manufacturing stance. The problem is, or the rhetoric that's happening in the media, is not about the actual activity, it's about the labor and the workers. What we're looking at is employment in the manufacturing sector. That orange line is private sector employment, so we're looking at 126.3 million workers right now in the overall U.S. Manufacturing employment is at 12.7 million. It's been rising since the Great Recession. And we're not saying that there's not a lot of new jobs happening in the manufacturing industry, but if you look back to early 2000s, manufacturing employment was 17% of private sector employment. Now, 2018, manufacturing employment is about 10% of overall employment. So there's a huge incentive with the rising wages right now, increasing technology that's driving cost flow and productivity higher, really incentivizing businesses to go out and automate, replace the human labor with automation technology, and that's what we're finding is a challenge. So you have to be adapting to that. Definitely start figuring out ways to automate your process, because we don't think, at least in the next 3 years or so, that the labor market's going to ease up. So it's still going to be very difficult for you to go out and find new talent. All right, let's talk prices. Let's talk commodities. What we're looking at here is mostly general decline in all of commodity prices. This is looking at a quarter-over-quarter basis, so that's that 312 rate of change that we went through. Other than steel, most are at little to negative growth. We see copper is down 7.3%. Copper is, they say, copper has a doctorate in economics because it's involved in so many different industries across the board that it moves with the market. And we like to track copper as an overall indication of where the economy is going to go. So all but steel, actually even including steel, recently demonstrated peaks. Right, so we see that that's a confirming signal that the economy is starting to, go on the decline. When demand starts to diminish in a slowing economy, that drives prices down. That's the law of supply and demand economics. The recent uptick in the steel prices likely driven by the tariffs, and that was again an inorganic way to limit supply that drove price up. But at the end of the day, it's starting to reconverge with the overall trends where we're seeing negativity happening. Again, this is looking at the rates of change. Remember when I talked about earlier, picking up the rates of change, the peaks, they happen before we see them happen in the actual data. So the top line data, actual prices, have yet to transition to decline, but we expect in the next couple months or so that at least copper in this case, I know that's one of the favorites of these commodities, will decline in 2019 because of limited demand, and that's going to drive that price down. So we've seen the business cycle transition to decline in copper prices, but it is yet to manifest itself in the actual quarterly price data, but definitely expect that these prices will decline in 2019 due to limited demand. Getting more 50,000-foot overview here, kind of more macroeconomic, is looking at overall consumer and producer prices. The blue line are producer prices. The orange line are consumer prices. So the orange line is reflective of you, me, going out every day shopping. The blue line is showing, as a business leader, how are my costs of doing business doing? Are they rising? Are they declining? What you'll notice is back in 15 and 16, where that blue line was well below the orange line, preserving my margins probably wasn't a huge concern. But looking at the steepness of that rise in that blue line since then, and where we are now at 3.4% compared to the 2.5 consumer price index, What that means is if you are not raising your prices, your margins are going to be eaten because producer prices are growing at a more aggressive rate than you're passing on to your consumers, indicating that's only going to slice out your profitability and your margins. You really have to be implementing price hikes. And the title slide there says, do it strategically and selectively. Understand what products are more vulnerable to price hikes. Understand what products may be more inelastic, meaning you can raise the price quite significantly without sacrifice to actual demand. Do it differently. Don't do a price hike equivalently across the board. Understand what products are more elastic or inelastic, and then raise your prices accordingly. All right, let's talk the long view. If many of you hear Brian and Alan on the road at all, you probably know about our expectations for 2030, and that's going to be another depression. And there's many factors that are leading into that. Right now, let's just look at a global economic perspective. We're seeing decline happening in the Eurozone Purchasing Managers Index, the European Union Manufacturing Purchasing Managers Index, and the JP Morgan Purchasing Managers Index as well. All in decline, really confirming our outlook for a recession in the industrial economy in late 2019 and to the early parts of 2020. But talking about 2030, it's going to mimic a very similar trend to what we saw in the early 1900s with the 29 crash. So what we're seeing here is looking at the overall trend in the U.S. economy from the 1900s, where we saw the Roaring 20s. There were many dips between 1920 and 1930, and that's what we expect out of the 2020s, where we're going to go through a couple of downturns. They're not going to be relatable to 2008, but we will feel them, and then it's going to be 2030, which is mimicked by the 1929-1930 depression, where that's where stuff will hit the fan. We're going to see a big decline coming out of 2030, and large reasons for that are the demographic trends. That's basically when the last baby boomer will retire. That's going to drive medical costs up. If we have a huge demographic moving into the era where they're going to require medical attention. We have our debt to GDP ratio right now extremely rising, where we're increasing debt, and that's reflected in this chart as well, where we're looking at a lot here, but basically what it's saying is our current transfer payments, that red line, is a lot higher than our current tax receipts right now, which are recently declining, indicating we can move the needle as much as we want on consumption expenditures or interest payments, which are still a concern. But if we don't make major changes to transfer payments, our debt to GDP ratio, our debt's just going to keep expanding, and then you add on the retiring baby boomers and inflation. 2030 is basically, there's going to be something like the straw on the camel's back that really collapses the U.S. economy. As of right now, we still expect this to happen. We don't, things can be changed in the near future to potentially change our outlook, but as of right now, if nothing changes, we're definitely heading into a ominous period as we head into the late 20s and early 30s. Brian and Alan have a great book discussing it. It's called Prosperity in the Age of Decline. It's a really good read. It lets you know how you can make money out of this recession or the depression that we're going through in 2030. That's when people make their money, right? They make their money in times of downturn, buy low, sell high. So if you know it's coming, you can prepare yourself personally and business perspective to really put yourself on top of everyone else in terms of the depression. All right, let's get into some business cycle drivers. This is getting a little bit more granular. We're looking at employment, we're looking at wages, retail sales, housing, and interest rates. Let's talk employment first. You saw this chart earlier. This is the top chart when we were looking at manufacturing employment compared to overall employment. So again, we're seeing record high record high employment, that makes sense. The population's always growing, the economy's always growing, requiring record high private sector employment activity. What you didn't see from before is our job openings growth rate. Job openings are up 12.2% right now and in phase B, indicating there's a lot of jobs out there, but we cannot find the workers. The economy is really hot right now. We're doing well. We're growing. We just cannot find the people out there. And we're also seeing a rising quit rate. Contrary to the negative connotation that quit has, in terms of looking at employment in the labor market, a rising quit rate is actually good. But as a business leader, it's not a good thing. So when the economy is doing well, there's enough security to be comfortable to quit your job and move to another job, a lot of poaching going on. That naturally raises the quit rate. So we're seeing a lot of people just get up and move to another job, especially with millennials now, getting married later, having babies later. They don't have the roots planted in the ground. They can easily get up and move to another location, and that's only going to hurt your retention. So you really need to be deploying proper strategies to try to keep retention high, because what this chart is showing is employment by age, and I like to look at the blue line as most of the millennials. And millennials are now the dominating demographic cohort in the labor market. And they think differently than the baby boomers and the Gen Xers. They actually are the first demographic cohort to value non-monetary benefits ahead of monetary benefits. So they really appreciate the work-life balance. They appreciate the vacation time. All of those non-monetary things they value more than monetary. Not saying they don't value monetary. You have to be raising your wages as well, just because of the inflationary environment and the tight labor market. But at the end of the day, retention will be helped if you deploy certain HR strategies that are tailored towards the non-monetary side of things. You also have the 55 to 64 age group bracket in a pretty noticeable rising trend. And the reason for that is people are retiring later now. So we're seeing a lot later retirement age that's driving the employment in that particular age group up. All right, let's talk retail. So the retail sector, we have everything, very different segments are faring better than others. So at the bottom of the barrel, we're seeing vehicle sales pretty much at stagnant growth, 0.5%. So that very little growth, I mean, you've probably read in the news somewhere about GM laying off a lot of their workers. We think the auto industry is an industry to tiptoe around. Not saying don't invest or don't do XYZ in the auto industry, but just keep your eyes on it. The delinquency rates are creeping up towards past the 10-year average for the delinquency rates. There's a little bit of risky lending. You can go out and get a 7 or 8 year car loan now with basically little no money in your pocket. They'll overlend. So we're seeing some type of risky behavior, and especially right now when the economy is thriving, we're all doing well. It's interesting to see that vehicle sales are actually basically stagnant. So come this time next year when the economy is going to be in a slowdown, this is like going to be kicking a dog when it's down in this particular industry. So definitely watch out. Just make sure you're keeping your eyes on that industry. And then contrary, the opposite, we have online retailers really thriving right now. So really good growth coming from the online sector, indicating you have to be tailoring your strategies towards the e-commerce industry. Even if you're B2B, there's a huge presence right now of B2B activity that's happening online. So really making sure that you have an attractive website to pull in those e-commerce users. And at the end of the day, what we found is that individuals spend most of their time on their phones searching things, and then they go and spend the money, the amount of dollars spent are actually coming from the desktop. So most people who, when they search for things, they're probably, at work or somewhere where they can just use their phone. Really making sure that your website is compatible to, the iPhones or the Droids of the world, because that's where people often spend their time, is on their phone looking at things. So really making sure you hone in on that as well, making your website attractive. All right, let's switch gears to housing. So this is one of the last topics of today, looking at the overall housing market. This is in phase C right now. So we're looking at single unit housing starts. Again, the top line there is showing the business cycle. So we've seen that declining green line, indicating we are in a slowdown. And the top or the bottom section there is actual housing starts activity. So over the past 12 months, single unit housing starts totaled almost 890 million units in the U.S. But again, rising interest rates will deter that ability for individuals to go out and buy the new home. Millennials are plagued now with a lot of student loan debt, and that's going to limit their ability to save up to purchase the new home. So we definitely think that this is going to be a driver to the decline. It's going to move similar to the macro economy, where it's going to be in a general decline in 2019, but then back on its feet again in 2020 when the overall economy starts to exit that downturn. Looking at the multifamily side of things, what we're looking at is somewhat the opposite, where we're actually in a growth position on the multifamily side of things. And this makes sense too, because typically when things start to slow down, when it costs a lot more to purchase a house, people migrate towards renting. So that's driving this particular industry into the positive. We can see if you look at where multi-unit housing starts are right now compared to the pre-recession levels, they're pretty much at where they were in the pre-Great Recession levels. So right now we're seeing growth out of the multifamily market compared to, if I go back to that chart we were just looking at the single unit housing starts compared to where it was before the Great Recession, not even close to what the numbers were going into 2006, 2007. So multifamily has definitely made a comeback, and with, again, millennials migrating to the metropolitan areas, that's going to be a huge influx of multi-unit housing starts as well. All right. Let's look at permits, because permits are a great leading indicator. The reason being, you need the permit in your hand before you can break ground on the start on housing. So it gives us extra insight to the future of the housing market if we're looking at permit data. So this makes sense with our overall outlook for the housing market, that it will slow down with those rising interest rates, and we're already seeing it reflective in the negativity out of that 3/12 rate of change. That gray line there is down 1.8%. So really suggesting we will face a little bit of a downturn, and depending on how you move with the housing market, if your business is operating in that particular realm, you'll likely feel a downturn as well in 2019 in line with the macro economy. Housing prices right now are above the pre-Great Recession levels. We're seeing some sharp rise happening out of housing prices. So don't expect, just because there's going to be a slowdown in the economy, that prices will drop significantly. Typically, you can see they rarely drop. What we're looking at is pretty much overall general rise. There's little, mini cycles in there, but all in all, housing prices typically are always rising just because of inflation. All right, so another thing that I mentioned earlier, that impacts the housing market, are looking at interest rates. So what we're showing here is the mortgage rates. That's that maroon line charted with the federal funds rate by the Federal Reserve. And they move typically hand in hand. So to see all these hikes happening with the federal funds rate, with Mr. Jay Powell making those hikes, we definitely expect mortgage rates to rise. They're at almost the highest in quite some time. So to see those rising interest rates really going to limit the incentive for individuals to go out and borrow if it's going to cost them more. And their forecast for interest rates, many of you probably saw this chart in the past, but it's 100% correlated to the height of the Federal Reserve Chairman at the time. So we have Volcker, we have Greenspan, we have Bernanke, Yellen, and now Mr. Jay Powell is there. So we definitely expect interest rates will continue to rise. To what degree? They're not going to be matched to what we went through in the 80s or the 90s. We definitely expect mild inflation. It's still going to happen, so definitely expect the cost of borrow to go up in the future. And a lot of it too is driven by what the regional feds are projecting as well. Now this can change the chairman, this is not set in stone, their expectations for interest rates. But as of right now, we expect, another one to happen this month, in early 2019, maybe another one. But long term, this is their projections for the interest rate environment. I want to know who this little sucker is over here in 2020. Talk to him maybe. But at the end of the day, definitely expect inflation to continue to play out as we head into the next couple years. All right, so recapping. 2017, 2018, good year. If you move with the economy, you should be feeling good, you should be feeling great. But now's the time, if you do move with the economy, to know that this is not going to last forever, that we are entering into a slowdown, and there are very different strategies to deploy in a slowdown that's going to give you that competitive advantage against your competition. Because if your competition is only seeing positive growth, which in phase C, that yellow area, that's still above zero, you're still growing year over year, but they're not aware that it's slowing growth, you're aware of it, it gives you that competitive advantage of where you're positioned on the cycle. And then early 2020, that's when we're going to be kind of starting to exit that downturn. So definitely expect something to happen. It will be mild, it will be brief, and then we're back on our feet again in 2020. All right, so some actionable takeaways. At the end of the day, I can give you all this information, but it's about what you do with it. So, I'm not going to read through all of these, but some are keep some dry powder ready for late 2019 and early 2020. Make sure your cash position is in a good spot where you can prepare and handle that downturn. Also, if you have some good cash at that point in time, that's when you buy at the bottom when valuations start to sink. Buy low, sell high. Automate, as I mentioned earlier with the labor market, a lot of incentives to go and automate. Late 2019 too, things will be costing probably less just because of the downturn that we're expecting. One that's not here that I really like to hone in on is dealing with your HR strategies towards keeping retention and training programs around. You really trying to keep retention high because this downturn is not going to be severe. Try not to cut back on any labor because it's going to cost you more when things come online again in 2020. It'll cost you more to try to recruit new labor than it would be if you just kept them around. All right, so you saw a lot of information today. You heard a lot of information. We have a great program called the ITR Trends Report. It's basically a monthly subscription that you can subscribe to and receive every month. And it's a snapshot of many different markets. I believe there's 40 plus markets that we have forecast for. We give you an update on where we expect them to go. So you can get a free 90-day trial offer by texting TR Trial to that number there, and you'll be signed up for that 3-month Trends Report outlook. So that's all for me, and I'd like to turn it over to Q&A at this point.
Thanks, Catherine. As a reminder, please submit any questions using your webinar toolbar. And we do have one question right off the bat. What determines whether you use a 312 ROC versus a 112 ROC as comparison to a 1212? So there are different answers to that. So there are many different reasons we choose to use a 112 or a 312 or a 1212. One is the way the data is collected. So the Purchasing Managers Index, the way that the data is collected, it allows us to use a 112 rate of change without making it extremely volatile. Because the way the data is collected, it's different than just taking numbers. It's an index that suggests, is manufacturing activity higher or lower or equal. So it depends on how the data is collected. It also depends on the stability of what we're looking at. So a smaller metric that we're tracking, the 312 rate of change might be extremely volatile. So we're going to be safer with that 1212 rate of change looking at that particular metric. So when we look at that, we also look at the volatility, making sure that what we're looking at is an actual transition to rise or decline. If a series is less volatile and more stable, we might be more comfortable to use that 312 rate of change knowing that it will be a more stable business cycle to work with. Thank you. We'll give it another minute or so for questions.
As a reminder, if you think of a question after the webinar, please feel free to email CAPSA headquarters and we will pass them along to ITR Economics. With that, this concludes our presentation. As a reminder, in a couple of hours, you will receive